This is Wealthy AF, your ultimate guide to understand what it truly means to be wealthy AF. And today's guest is a special guest to me because I've been following Neal for a very long time with Neal Bawa. And Neal Bawa is a technologist who is universally known in the real estate circle as the mad scientist of multifamily. Besides being one of the most in-demand speakers in commercial real estate, Neal is a data guru, process freak, as he calls himself, an outsourcing expert. Neal treats his $1 billion portfolio, I think it's a little bit lower than that now, you mentioned last time we spoke, Neal, as an ongoing experiment in efficiency optimization. The mad scientist lives by two mantras. His first mantra is that we can only manage what we measure. His second is that data beats gut feel by a million miles. I love that one, Neal. Thank you for coming on, brother, and welcome.
Well, thanks for having me on the show. I think that these are really things that I live by. And every part of my life, not just my professional career, every part of my life is influenced by these two things. I measure everything. I measure, and then some of them are silly. You might get a chuckle out of it, right? I measure how much I sleep. I measure how often I have sex. I measure, every part of my life. I measure how far my right arm stretches backwards. I had an injury there two or 3 years ago, so I know it currently stretches 57 degrees. And at its worst, it would only stretch about 41 degrees, which is really, really bad. So I'd lost all of my mobility there. I think this is a mindset. You don't say, hey, I do underwriting, I do math. The answer is you live your life by these two mantras. That data truly, truly beats gut feel. And as a result, I have become an obsessive user of ChatGPT. I use it at least 15 or 20 times a day because it helps me with that data.
Tell us how you use ChatGPT as a multifamily investor. Give us an example of that.
I use it in lots and lots of different ways, right? So firstly, it helps me with research. As you know, ChatGPT was recently updated, so it has very recent data. And that recent data includes documentation from all of my favorite sources. So I could go into my email and I could start searching for documents about Marcus and Millichap or this or that or everything else. Or I could just simply have my assistant, export these or throw them into ChatGPT. So if you have a channel in ChatGPT, as you know, you can have lots of channels there, right? Hundreds of different channels, things that you ask them. So one of our channels is every time we see a research paper, right, we throw it into that channel. So it's just a simple matter of dragging and dropping, right? And so that channel now knows information from Marcus and Millichap and CBRE and Berkadia. And just imagine like all of the research papers that we get every single week, all of them being in one place, in one channel, right? Now we have a ChatGPT that basically is extraordinarily smart about the specific things that are happening in our industry, whether they're cap rates or delinquency levels or banks being behind or, the 100 or 1,000 other things that these people provide in their webinars and their decks and things like that. It's all going into that one channel. And so when I then go and ask questions about, let's say a question that I asked a few weeks ago, when do we expect Austin to start seeing positive rent growth? Well, it isn't just coming up with information from the web. It's actually referencing and reading all of the recent documentation, let's call it several hundred documents from the top 10 brokers in the United States and the top 10 lenders in the United States. There's Fannie Mae, there's Freddie Mac, there's, Walker Dunlop. All that stuff is in there. So now we've made it ultra smart and ultra recent because all this stuff is from the last 3 months. We'll clean out all the older stuff because we don't want it to be reading stuff from 6 months ago, right? By doing so, we have ChatGPT Turbo for commercial real estate that we created ourselves by simply dragging documents into one channel.
That's brilliant, man. That's brilliant. Tell us, what have you uncovered? Give us some meat and potatoes, man, because you're a brilliant guy, Neal. So what have you uncovered about the Austin market and when will it recover? What does the data tell you?
So I, in general, agree with ChatGPT's commentary. Austin still remains possibly the best market in the United States. What some people may say it's Dallas, and that would be a reasonable argument as well. I said arguably, but it's clearly one of the top 3 markets in the U.S., in terms of potential 10-year profit. So if I look at 10 years, where do I want to invest? I have $1 billion. I want to invest it, but I only want to invest in one market. Well, my picks probably are going to be Phoenix, Dallas, Austin. These are my 3 picks. So that, according to ChatGPT, and I agree, it really hasn't changed. Fundamentals, nothing's really changed there in terms of job growth and everything else. What is clear is that Austin is seeing negative rent growth. So according to ChatGPT, it's about 2.5%, but then ChatGPT points out that one document said 6%. Those are probably over two different time frames, and ChatGPT points that out. But bottom line is there's negative rent growth. There's also negative home price growth. ChatGPT understands fully, thanks to these documents, that when there's negative home price growth, meaning home prices are falling, often rent growth will fall as well, because now homes are becoming a bit cheaper. So some people are able to move from apartments into homes, and that can affect your overall occupancy, and it can also affect your rent growth. Home prices have dropped in Austin by about 6 and 7%. And so bottom line is, Austin may be a brilliant market to invest in at the end of this year or the beginning of next year, like Q1 of next year, because unlike the nationwide market, which appears to have hit a bottom in Q2, and I'll explain why I believe that, the Austin market, having been hammered too much by incoming supply and having gone up too much in rent growth and now adjusting, is probably not going to bottom until either Q4 of this year or Q1 of next year. Other than that, brilliant market.
Okay. So what you're looking at, basically, you're looking at the 10-year span, though. That's still Neal Bawa's top 3 market, you said.
Well, again, I think that I'm trying to answer your question as succinctly as I can be. It may not be in my top 3 markets simply because I think it's still a little bit expensive. Mm-hmm. But in the scenario that I had $1 billion and I was willing to invest for 10 years, it would unquestionably be one of 3. As it happens, I don't have $1 billion, and my investors like to invest for 5-year terms. So there may be other markets that come ahead of Austin. But what really happens is ChatGPT allows me to, and the way I use ChatGPT, I exclusively use it in one way. I open the ChatGPT app, I go in and I basically talk. I talk for several minutes. I make mistakes, I correct myself. And when I've finished talking for several minutes, I say, please structure my thoughts. And when it structures my thoughts, then I put those thoughts on my Mac. And then I basically give it edits, and it structures the thoughts again and again and again. And after 3 or 4 or 5 times, when it's done, I export that as a Microsoft Word file, which it's capable of doing. And then I send it to my project manager. His name is Afzal. He's in Pakistan. I send it to him and say, please create this as a project spec. And he creates it as a project spec. In my spec, I basically mention who are all the other people that are involved. And then he puts that together and turns it into a project in Asana, and the people start working on those tasks. So for example, recently I came up with ideas about Northwest Arkansas. So I did a huge amount of research. ChatGPT helped me. We pulled a bunch of reports, threw those into ChatGPT, and basically we realized this is a phenomenal, absolutely incredible 10-year market. And so we created a project spec with hundreds of tasks that our team members have to do. People have to fly to Northwest Arkansas. They have to roam around there for 2 years. The underwriter has to call at least 3 lenders, the usual stuff of penetrating a new market. And all of that was structured through conversations with ChatGPT and a project spec that ChatGPT designed based on my requests. This accelerates us at least 2x. I mean, we are seeing easily 2x acceleration in our business.
Wow, that's amazing the way you're using ChatGPT. So I'm sure the listeners are taking notes. I know I'm taking notes on some strategies that I'm going to be deploying myself just to improve my business. Neal, as it pertains to 2024 here, as we record this, we had the feds come out, and it was you at the LA meeting that taught me about the Fed.plot. You were the one that educated me on the Fed.plot. I didn't know that website existed. As it pertains to what's happening in the overall economic landscape, what are you seeing? When do you see us? First of all, do you think we're in a recession, Neal? And do you think the data the government is, I know it's a little bit loaded question, do you think the data the government is giving us is accurate? I'll start there before we dig into the weeds, because I know you're a guru. Your mind is just with the data. You're brilliant with it.
Anything that you hear from Republicans or Democrats is not accurate, because both of them shade it. Republicans want to show a lower number and Democrats want to show a higher number. I specifically do not take any of my economic data from politicians. I also don't take it from the Treasury Department, because the Treasury Department supports the president. I absolutely believe in data. Absolutely have 100% believe in data that comes from the St. Louis Fed or the Atlanta Fed. So if you look at the Federal
Well,
Reserve
that's where
websites, they
you look.
publish data.
That's where you look. St. Louis Fed.
Correct. So St. Louis Fed and the Atlanta Fed, there are a number of Feds. So there's New York Fed as well.
Mm-hmm.
But in terms of data publishing, it's the St. Louis Fed and the Atlanta Fed that are traditionally the ones that put out the reports that the public likes to read. People like me that are not, economists, but have a good understanding of the economy like to read. The data there is absolutely not biased by politics in any way at all. Because, if you look at the last 4 or 5 months, I mean, inflation is clearly flatlined, meaning it's not going down anymore, right?
Mm-hmm.
And that can't possibly be good for the Democrats. It can't possibly be good, right? But that data is coming from, Atlanta Fed, St. Louis Fed, and it appears to be very clean, very, very clean data. So absolutely, I trust that data. I trust it implicitly. When I see the inflation numbers come out, I trust those because the way that we calculate inflation is not correct. So inflation is slightly higher, but it is not 8 or 9 or 10% that other conspiracy websites mention. Those are absolutely rubbish numbers. I think those are wonderful conspiracies and good for coffee table talk, but are not accurate numbers. Inflation is roughly 1 to 1.5% per year higher than the ones that are in these numbers. Having said that, on a relative basis, these numbers are correct. So if 1 month it says 3.2 and the next month it says 2.7, it's declined by 0.5%. Well, that decline is correct, right? The overall number may actually be 3.7, to decline at 3.2, but still that 50 basis points decline or 0.5% decline, that's accurate. So we are seeing the right data. So, but, to go back to your question, you said, what's happening with rates this year, next year? The short answer is the Fed dot plot 18 months ago. The dot plot is a simple, very simple thing. There are a number of federal governors that are voting, and then some are non-voting. Each of the voting governors, at the end of each Fed meeting, there are 6 of them every year, is given a sheet and is given a pencil. Using the pencil, each one of those governors puts in where he thinks rates are going to be each quarter for the next 8 quarters. So the pencil mark them down. Now, let's say I'm a Fed governor that believes that rates are smoothly going to decline. Well, I'll probably go like this, then a little lower, then a little lower, then a little lower, then a little lower, right? That's what represents my beliefs. So, and then they aggregate it together, right? Average it out and publish it to the web as this is what the Fed thinks is going to happen to interest rates. It is known as the Fed dot plot, right? And that basically shows a direction of interest rates. The Fed dot plot continues to show a downward expected direction of interest rates. The change that has happened is initially the Fed felt that they would cut rates 3 times this year, 2024, and they would cut 3 times next year, 2025. So 3 plus 3, 25 basis points or 0.25%, which means that by the end of next year, rates will be down 1.5%. So if the mortgage rate is 7% today, then it would be expected to be roughly, 1.5% lower than that. The Fed dot plot has changed because of inflation refusing to come down. It's obviously come down from 9.2% to 2.7%. The latest reading, which was in June of 2024, is 2.7%. For the Fed's favorite method, there's multiple ways of calculating inflation. The Fed's favorite is PCE. PCE is currently at 2.7%. And it has been very difficult to get the PCE down from about 3.4% to 2.7%. It's taken pretty much the whole year. The Fed didn't anticipate that. They thought it would come down a little bit more. So the Fed's dot plot now says 1 cut for 2024, and then 4 cuts for next year. So now we've gone from 1.5% to 1.25%, right? But at the end of 2026, the Fed's dot plot, with all these changes and inflation being sticky, all this bad stuff that you hear about on MSNBC and Fox News, the only change has been 1/4 point cut, right? So there's 1 extra next year, 2 less this year. Overall, it averages out to 1/4 point less in cuts. Very small change.
If you were, with everything you know today and all of your experience, Neal, right? I remember talking to you and you told me you started buying duplexes and smaller stuff in 2009, I think it was, you said, last conversation, somewhere in that. If we take everything that Neal knows today and all of his experience and all of this knowledge on data that you have today, and you were starting over today, what would Neal be doing and what would Neal be buying to create wealth? in real estate?
I wouldn't buy any real estate. I would simply buy as much Bitcoin as I could in 2009. But that was the easy answer. You sort of teed it up for me, right? So the honest answer though is if I cannot go back to the past, if I have to start today, right? So knowing what I know today, I think that I would probably be doing a lot of real estate because, and this is not something that's news to anybody, but I think I'm going to try and break this down. Our federal debt is exploding at an exponential rate. And when people sometimes don't understand exponential, right? So a best way of an analogy is if you have a stadium and the stadium is waterproof, right? And what you're doing is you're basically dropping one drop, right, into that stadium, one single drop every minute, right? You ask people how many minutes will it take, and that one drop doubles to 2. So the next minute is 2, and then it's 4, then 6, then it's 8, then it's 16, right? So drop doubles. And you ask people, how long would it take to fill an entire stadium, let's say the stadium in Santa Clara, with water? The answer is only 57 minutes, right? So even though you're starting with 1 drop, then 2 drops, then 4 drops, then 8 drops, it would only take 57 minutes to fill an entire stadium with water. And if the question is, when would you die? Well, you die a lot more before 57 minutes. You'd probably be dead at 50, right? Because the water is going to go up to the bleachers. Bottom line is, most people don't understand exponential curves. People understand linear, 10, 11, 12. That's what we've been taught in school. Well, our federal debt is exponential. Also, exponential doesn't mean that there's a problem because the exponentials have a shallow curve and a steep curve. Shallow, steep. We've been on the shallow part of the curve until about 2016, 2017. Now we're on the steep part of the curve. And the steep part of the curve doesn't just go shallow and then steep. It starts to get steeper and steeper and steeper and sharper. So we are now accelerating along that, where our federal deficit increases by more than $1 trillion every year, multiple $1 trillion, which means that our federal deficit now goes up by more in a year than it used to go up in 2 decades, just 40 years ago, right? And that is extraordinarily, impossibly, difficult to control. And it's not going to happen because neither party actually has the political will to do it. As a result, at some point in our future, almost impossible to predict, so I won't bother predicting it, but within the next 10 years, because actually if I take the exponential curve and extend it over the next 10 years, it's clear that this catastrophic event must occur in the next 10 years. At some point in the next 10 years, people won't buy US treasuries. The moment that happens, interest rates will skyrocket, which the moment that happens, the value of assets go up like crazy. Like you would get, you could get real estate doubling in a single year. Doubling, right? So remember, a building only needs to go up about 30 to 40% for investors to double their money because we're using leverage. If a building doubles, then you get, 5x, 6x returns. So that is inevitable. That will happen. And I'll give you a perfect example. People don't study what's happening in the world where Americans are a very self-centered people. There are 5 countries in the world experiencing exactly that right now. So we have to learn from all 5. And some of them I've studied more than others. The countries are Argentina, Turkey, Nigeria, Oman, and Pakistan. Also Sri Lanka, but that was more last year. In these 5 countries, what I just described is happening. That exponential curve became so sharp that the country basically has debt issues. And so interest rates in Turkey are in the 54% range.
What?
54%. In Turkey, 54%. And still their inflation is somewhere in the 80s or 90%. Now, so you might say, so what's happening to real estate? It's doubled. So anyone that was holding real estate in Turkey 1 year ago has made out like a bandit because that real estate is worth double now. And if they were using leverage, let's say they were using 25% down, they've probably made 4x in a single year. Now, let's look at Argentina. What's happened to real estate there? It's doubled, right? Argentina has very similar numbers to Turkey. Nigeria is slightly better. Pakistan slightly better. So what I'm seeing is these countries, because they are not the reserve currency of the world, reach their exponential curve. They're reaching the sharp end of the exponential curve. And I'm observing what is happening to real estate. And it's not all good news. They're suffering. The people that are landlords in Turkey today are suffering. Why? Because they have 1-year rent contracts. And those 1-year rent contracts, now that they're signed, if inflation goes up 80%, your employee payroll goes up by 80%, correct? But you are not able to raise your rents that quickly, right? You obviously, each lease as it renews, you're going up 80%, but it's painful. So they may not be making any money at all, but their property value has more than doubled. So they can at any point of time sell their properties, get out and make a huge amount of profit. Does that make sense?
That makes sense.
So bottom line is, the world, this isn't a U.S. problem. People sort of sometimes think that this is an American problem. No, it's not. We're not even in the top 10 list of countries that are most indebted. The countries that come to mind that are most indebted are countries like China and Japan and Italy and Ireland. I mean, there's countries that are way ahead of us on this curve. And now we're starting to observe what is happening to these countries that are way ahead of us on the curve. And consistently, I'm seeing it's good news for real estate people, though it's very painful when it happens, because it's very hard to raise rents on a 1-year fixed contract while, everything's exploding. So you really have to manage at that point of time your expenses very tightly. But if you can just manage for a year in hyperinflation, you end up making incredible amounts of money. Like I would just simply exit my businesses by selling everything at that point of time. That is my core belief. And I've taken a lot of time here, so I'll stop here. But that core belief means that, to answer your question, I would be buying a lot of real estate.
So if you believe that, right, which I've heard a lot of really smart people also say similar things, our debt is just going through the roof. If you believe that, and we expect something like this to happen eventually, most people don't know. You hear really smart people say things like, hey, we're in the beginning of the downfall of an empire, right, of the American empire, our debt and everything else going on in our country. How can we as investors, the listeners, you, myself, guys that own real estate or guys that are buying real estate, how would we hedge our bet? How are you planning, and how are you strategizing to capitalize on that? Because as Napoleon Hill says in his great book, Think and Grow Rich, with every adversity comes an equal to or greater than opportunity. Where is the opportunity, and how is Neal hedging his bet within that opportunity?
Sure. I'll start by saying this. There is absolutely no likelihood of the American empire ending, right? If you study empires that have ended, the Turkish Empire, the Roman Empire, right? Other empires that have come to an end, the Chinese Empire, we are currently not experiencing the conditions that caused those empires to end. In fact, the American empire is extraordinarily strong because we are technologically still by far the powerhouse of the world. If you look at all of the new technology, including the most powerful technology ever invented by man, AI, all of it is being done here. We have not lost our ability to be cutting edge in anything. And as a result, if there is one country that I want to be in when the world starts to go through these conniptions, it would be the United States of America. I have absolutely no doubt. So I do not believe that the American empire is either at risk or ending. That doesn't change the fact that we are likely to go through hyperinflation. And when we do, it will be exceedingly painful for us, but probably a lot less painful for us than for other countries in the world. So bottom line is, I'm hedging my bets by buying real estate today, because here's what's likely to happen. You asked me about interest rates, right? I believe that interest rates are on a downward curve. They'll go down, and by 2026, they should be back down to 2019 level. We'll never see the nonsense that we saw after COVID, because obviously rates were set to zero. They shouldn't have been, whatever, it's done. That was a one-time occurrence tied to a black swan. But by 2019, we're pretty normal rates, right? So I think we're going to go back to 2019 by the end of 2026. But this event that I'm talking about, the next black swan, which is essentially a fiscal crisis because of debt being too high, I don't know when it occurs, right? So I'm simply not going to take actions on the basis of it, but I'm going to make the assumption that it happens. Well, then I want to have as much fixed debt as possible. I want to have as many properties that I can buy. At least my debt will be fixed during the period of hyperinflation, which means that my property value will go up so fast that even if I'm negative on my expenses, my expenses are going up, I can just simply refinance the property and get more debt at that point in time because my equity is going up very fast. So holding as many assets as I can with fixed debt is my plan. And there really needs to be nothing else to that plan. Buy buildings, manage them well, and somewhere in the next 5 to 10 years, you will have a shockingly large, exit event occur. And that event will be so large that you'll be done for this life.
I recently read an article, I think it was this morning, where Saudi Arabia, I don't know if you saw that, decided to get off the petrodollar, right? So what are your thoughts on that? What are your thoughts on, and what impact do you see that having on us as real estate investors, if anything, right? These countries and these nations, like the BRICS nations, are trying to take down the dollar. They've been trying, and there's different, I hear different opinions. I'd like to get your opinion. What impact will this have on us as investors, just investors in general? Saudi Arabia is a powerhouse. They're an oil powerhouse as it pertains to oil. And now they decided to trade oil in other currencies other than the dollar. That just happened a couple of days ago. I just read that. What are your thoughts on that?
It means nothing in the long run, but in the short term, it is painful. There's this belief that somehow these other countries have a choice. The truth is the dollar is the only stable currency in the world. You could say that about the euro as well, but to a lesser extent. What's actually happening is people are saying, well, I'll trade in yuan, I'll trade in rubles, I'll trade in all these other kind of currencies. But these currencies fluctuate so much that it's actually pain for people to do those things than to trade in dollars. Secondly, our needs to be the reserve currency of the world are declining. America's need to be the reserve currency of the world, the biggest reason for it was our massive oil bill. So in 2005, I believe, the United States had the biggest oil bill ever because what's happening is, we have our own oil wells, and those wells were depleting since the 70s. 70s, I think, was the peak of our previous peak of our oil output. And then it was declining. By 2005, it was very important to us that all oil be traded in dollars because that arbitrage was giving us a benefit. We were buying up almost 8-9 million barrels a day. Today, the situation, because of the miracle of fracking, has completely turned around. The United States is the world's largest producer of oil and oil equivalents. It's not Saudi Arabia. It's not Russia. Russia and Saudi Arabia are in position 2 and 3. The United States is the world's largest producer. We're not the world's largest exporter. The reason for that is we're consuming a lot of our own oil and gas. But what's happening is the percentage of oil and gas that we use that is coming from other countries, especially hostile countries, especially countries in the Middle East, is continuously falling. By next year, it'll be close to zero. So the bottom line is, because we are entirely self-sufficient and continuing to raise output, right? Last month was the largest oil and oil equivalent output in American history. Please read this. Most people are like, no. How's that even possible? We import all this oil. Sure, for the purposes of business, it is normal for simultaneously for you to be exporting oil to one country and importing oil from another. It's a wash, right? That's just profit because it made sense to do those kinds of things. I'll sell oil to this country and I'll buy oil from that country. Maybe that country happens to be closer to me, so I'll buy it from there. And I'll sell it to that country because they're paying me more. So I'll pay, I'll send my oil there. That happens. That's normal. Bottom line is we're not dependent on other countries for energy anymore. And I don't expect, given the astonishing increase in renewable energy and the costs going down, I don't expect that the United States will ever depend on another country anytime in the future for our energy needs. We are now, for the next 100 years, energy self-sufficient. So our need for a petrodollar has declined tremendously compared to 2004 or 5 when we were at the peak of importing. Is it nice to be the reserve currency of the world? Yes. You need to be the reserve currency of the world to get cheap loans. No. Is Japan the reserve currency of the world? No. Currently, Japan sells 10-year bonds at 1.5%. 1.5%. They're not the reserve currency of the world. They're a country whose GDP has not grown for 3 decades. Their population is declining, and they're able to sell bonds for 1.5%. Look at the Eurozone, right? You look at the Eurozone, they've got much lower growth than us. Their population is not growing anywhere near at the US level. Their percentage of world GDP is declining. They're able to sell bonds for 1.5%. Even deadbeat countries like Italy, who really should be at 10%, are able to sell bonds at under 2%. So there's this belief that somehow you can't raise money if you're not the reserve currency of the world. It's a completely bullshit belief. How do other countries, sell bonds at 1 or 2%? They're not reserve currencies. So there's a huge number of conspiracy theories that go around on the web. So I'll simply say this: the portion of that is true is that it is beneficial for the United States to have, dollars, to have oil traded in dollars. It's beneficial for the United States to stay the reserve currency of the world. But our position is not threatened. No, if you look at the basket of currencies being used around the world, the dollar stays dominant. And that's what we need. We need to be number one. We don't need to be the only currency. We just need to be number one. And no one is close to us. Other countries are having so many problems of their own, but less and less countries are buying their currency. People used to hold tons of Russian rubles. Show me one country in the world that's now holding Russian rubles.
Yeah. I want to, you talked a little bit, you mentioned population growth, and that's one of the drivers for us as real estate guys, right? It's also, I believe, it's one of the drivers for GDP and growth and economy.
It is.
Last time you and I spoke, I shared some data that I found, and you're the data guy. So on immigration, it was around 4 million, and this was a few months ago. I was listening to an acquaintance of yours. I believe you and Ken McElroy or you guys were speaking on the same page. Yeah, you guys are friends. And I was watching a podcast with Kenny a week ago, and he had reported that, I can't remember where he sourced the data from, that the new number that they're telling us now on new immigrants is between 6 to 10 million new immigrants.
Yes, that's right.
That being the case, what impact do you see that having on our economy on a global GDP scale, right, as America, right? Because population growth, you said it, no other country is growing as fast as we are. What impact will that have, obviously, as a country, to us economically? And number two, what impact do you see that having on housing and real estate?
The United States generic population growth, if you keep the immigrants aside for a moment, so keep them aside, because that number goes up and down, right? Depending upon who's in power, things like that, is falling, and it's falling catastrophically compared to around 2012, where the country was growing at almost 1%. By 2021, we were growing at a third of that level. The decline in population growth. We're not a declining population. Population is still going up, but the rate at which it goes up, a healthy rate is about 1%, and an unhealthy rate is about 0.3%, and that's where we were, in 2020. Then it started, that 0.3 started to adjust again, and as you said, it's almost entirely, almost 100% because of illegal and legal immigration or semi-legal immigration. We don't have a lot of legal immigration to the U.S. right now, so a lot of it is semi-legal and illegal immigration from the southern border. I don't think the $10 million person number is correct. I think that's overstated, but I think that the number for the last 3 or 4 years is around 6 million. So he said 6 to 10 million. I believe that 6 million number is actually the right one. I can tell you that if we did not have that 6 million, worth of people coming in that time frame, we would not have the booming economy we have today. So these people have good and bad effects. Number one, they're driving up inflation because they're driving up demand for housing. Housing is the biggest single component of inflation. They're obviously driving up demand for food because 6 million people have to eat. So they're increasing inflation in the United States. But they're unquestionably having a positive effect on our GDP, on our growth. So this is well known. Now, obviously, we're a polarized country, so somebody somewhere will basically say what I'm saying is, it's because I'm a Democrat or a Republican. So for the record, I hate both parties. From the depth of my soul, I think that they're disgusting, and I want to have nothing to do with them. I'm an independent. And there are times when I don't even see the point of voting because I'd like to have a third option. Bottom line is that to me, it's abundantly clear that in general, when we look across 100 countries in the world, immigration is positive for GDP, but it also causes inflation. Does immigrant take jobs? Do immigrants take jobs away from the country that they move into? Yes and no, and I'll explain why. If too many of them come in at over a short amount of time, which is what happened here, they do take jobs away from us. If there is a steady stream, so if these 6 million people were distributed over twice the number of years, job losses would be minimal, and the increase in GDP would more than compensate for it. But there's just been so many of them coming in such a short amount of time that the negative impact is that all of these people now have to be housed by the government. You know, they're getting food stamps, things like that. So there's a negative impact there. So the best way for the U.S. economy to grow is to have immigration, but not the kind of uncontrolled immigration that we have had in the last 4 years. This is devastating.
What impact do you see? Why do you say it's devastating? What negative impact are you seeing that you're saying is devastating? Because you mentioned a lot of good things, right? Hey, GDP.
Well, firstly, there's job losses for Americans, right? So people that live here are seeing substantial job losses as these people come in and take over any kind of job. The second is it basically creates a state where there's a huge social net that has to be expanded to cover people who are not yet set up. They don't have enough money, and that social net costs a great deal of money. Now, what does it mean for real estate? There is no negative for real estate. I mean, specifically talking about real estate, there's only positives. I mean, all these people need to be housed, right? So they go into Class D properties, the D people move up to C, the C people move up to B. All along the chain, there is an increase in demand. We've been talking about rent growth in the United States being flat for the last 12 months, but do you know that occupancy is still phenomenally strong, and the United States absorbed 400,000 apartment units last year? I'm positive that the vast majority of that 400,000 of positive absorption came from immigration. Where else could it have come from? Right. If we don't have, people, if we don't have births in this country, if we don't have, more people coming in, then the demand for real estate is not going to just go up for no reason. It has to, the demand has to come from somewhere. Well, right now it's coming from immigration. So, particularly for multifamily people, apartment people, especially Class C apartment people, this onslaught of people coming in from the southern border only has positive, connotations, no negative ones that I can speak of.
Amazing. How did you address the concerns about housing affordability and even when you're considering, because these people are going to push, like you said, they're going to push rents up, right? So in your opinion, what is the solution for us as investors? I was talking to a group of guys a couple of days ago, and they asked me a question. This actually in my mastermind, this very topic came up. We were talking about immigration, and we were talking about strategies and things like that. I said, hey, guys, I'm literally building my business based on this data, right? I'm looking down the line, and it just, as a real estate guy, if we got more people coming in, just what you said, right? We got more people coming in, we got to house them, higher demand, higher rents. How do you navigate the affordability issue? Because we're not seeing wages go up as fast as these rent prices are going to go up while they're flat. But it's just simple to me, simple math is if I got all these people that are going to put pressure on housing, right? That means that prices got to go up. It's just simple economics, right? Supply and demand. How do you suggest we navigate that? How do we navigate that as Americans, right? As consumers, and how do we navigate that as landlords, right? Because I think it was another one of your friends, the real estate guys. I was listening to those guys, and they were saying, the big bad. You've been on that podcast multiple times, and a lot of times people see the landlords as the big bad landlords, and we're just going. We don't dictate what the rent price is. The market does, right? Demand does, right?
Sure.
So how do we navigate that, and how do we manage affordability, and how do we stay in business and still help people, right? Because we are providing a service, a very important service.
Okay, I'll give you an answer to that. So first, I'm just going to look everybody in the eye and say this. You are making profit in real estate because there's a demand-supply imbalance. that is the reason why real estate is so profitable. So if you want to come back to me and say, hey, how do we address this imbalance? I don't see anybody doing that. I don't see Neal Bawa addressing the imbalance. I don't see the 10,000 syndicators. We're all taking advantage of the imbalance. You're giving us money because there is an imbalance. So the answer to your question is the only party that can actually make a difference is Congress. Congress can take actions that would result in the imbalance either being solved or reduced. I don't see either party even on their agenda having housing as a significant issue. The Democrats talk about it more than the Republicans, but they don't actually do anything, so it really doesn't matter. So with the exception of governmental action, I don't know of a way for us to make a difference on a big scale, right? Whether it's 1.7 million units or 4.7 million units that are short, two different Freddie Mac reports, there's a shortage, and there doesn't seem to be any governmental action happening. Usually the private sector jumps in and they build a lot of stuff. We built a ton of stuff last year, and this year you can see the massive amount of deliveries. So the private sector fixes the problem by simply creating more stock, but the private sector is currently unable to do so because interest rates are very high. So new construction has slowed dramatically for multifamily. It hasn't slowed dramatically for single family, by the way, because their prices haven't dropped at all. Multifamily prices have dropped, single family haven't. So they're merely building as many as they can. So bottom line is that I don't see the industry doing anything on a scale level to address this problem at all. I do think there are examples of companies like Disrupt Equity doing things at a smaller scale, and I sit on their nonprofit board. So what Disrupt does is they take 25% of their asset management fees, and they basically funnel it back into their properties as subsidies for tenants that lose their jobs, or that they lost their car or something bad happened, and they sort of get them back on their feet, because people normally are able to pay rent, but then there are months where they have higher expenses or something happens on the healthcare side. So I think companies, what I would encourage syndicators to do is to do what Disrupt Equity is doing, right? It's called Disrupt Gift. You can check it out. What they're doing is they're taking a portion of their asset management fees and giving it back to those people that need help in their communities. I think that's the best way to help on a micro level. But otherwise, I think we're all benefiting from this imbalance. On a nonprofit level or a mission level, we need to start companies like Mission 10K. Mission 10K, which is mission10k.com, is a company that is building 10,000 affordable townhomes for rent. 10,000 affordable townhomes for rent. And so by the time we finish building it, we'd actually have made a dent in that total number. We'd have made a dent. So I think what I'm doing is, on my plan A is, buy buildings, benefit from the imbalance, make money for my investors. Plan B is funnel money into a company that is adding stock. So if I leave this planet having added 10,000 units to American stock, I think I've done enough. I think I'm pretty satisfied with that. So now this is my bi-directional approach. On the one side, I am a clear beneficiary of demand-supply gaps, and I'm just as shameless as any other landlords. If I can raise rents by 10%, I'll do so. On the other side, I'm adding 10,000 units of stock, and that will reduce overall the demand-supply imbalance. Those are the two things that I'm doing. And I think what Disrupt is doing is something in the middle.
Yeah, which is really good. It's a real problem. It's a real problem. As a landlord, you being a landlord, me being a landlord, we know the stories. We know the stories. People struggling to pay their bills. Some people struggling to pay their bills, while the economy shows us. You're in the A-class space. You have a lot of A-class buildings. I know that. I've seen.
I have A's and C's, both of them. Yeah.
I'm the C's. I'm strictly in the C's. I don't have any A's, C's and B's, but. We hear the story. I know the media likes to tell us, that we're doing great and this and that, but man, the middle America is feeling it. Middle America, and I know because of our residents. I also, Kenny talks about this too in his podcast. He's talking because I think he has 10,000 doors, and they surveyed their people. It's really interesting, the disconnect from what we're hearing. GDP, we're doing so great. The stock market's doing so great, but the regular working class people that are renting from you and I are not feeling that great right now. So, man, it's a real problem to be fixed. I'm like you. Hey, I'm a capitalist, and at the same time, I also have a heart, and I want to give back, and I want to be able to help people and produce. Neil, it's been my pleasure, my honor to have you here. I know you're a busy guy, and I want to make sure I'm respectful of your time. If folks wanted to connect with you, Neil, how do they connect with you? Where do they find you? I know you're doing a lot of things. If people wanted to invest in your deals and things like that, how do they connect with you, brother?
Two ways. I happen to be the only Neal Bawa on the World Wide Web. So if you type in NEAL space BAWA, you'll see thousands of articles and videos about me. You can start there. The structured way, if the faster way, is to go to multifamilyu.com. That's multifamily followed by the letter u.com. And when you go there, you will see all of our content. We do 12 very fun, interesting, data-driven webinars each year, and about 30,000 people register for these webinars and attend them. And then during those webinars, whenever we need money, you'll see sort of a 60-second little ad in there for whatever our next project is. And if you feel you can join it, don't be in a hurry. That money is definitely not burning a hole in your pocket. I guarantee that.
Where are you speaking next? Where are you teaching next? I know you do a lot of trainings, a lot of speaking.
So I just came back from the doctors conference in Detroit. I might be speaking at the MFIN conference in Denver. That's coming up. I think that's going to be in July. There's the Old Capital conference that tends to be in September, October. I like to speak there. A lot of conferences are actually earlier in the year or pretty late. So because the holidays come up, I actually don't teach very often in July and August. I am teaching at the Leadership Conference in Las Vegas on the 30th of July.
Okay, yeah. So people wanted to follow you, or they wanted to attend one of your live events, which are amazing. I mean, the experience with Neal it's amazing over a podcast. And that's how I came acquainted with you, was over a podcast, and also been in events where you've been the keynote. So thank you, Neal. Really appreciate it. Are those events on your website, Neal? So if people go to Multifamily U and they wanted to know where you were going to be speaking at next, will they be able to see it there?
That's a good point. No, we don't publish these events, and we should. So that's a mental note for me.
Yeah, I'll take mental notes, man, because I know that if I'm listening to you and, Neal's like, hey, I'm going to be at this event, I'd consider checking it out and going to it. So just a thought, my friend. Well, thank you. Really appreciate you, Neal. Thank you for coming on. It's my honor, my pleasure, and love to have you back. This is your home, Neal.
Thanks for having me on.